Hi friends, this is Madhu Reddy. Welcome to the Money Breeder. Today I am going to discuss one of my favorite and most successful strategy in and out. The strategy is having good success rate and I am making the good money. And also every day I am going to post this strategy in my Telegram channel about my positions as well. Okay, before going into the strategy details, this is the standard disclaimer. In case you wanted to attempt any trades, any stocks which I am discussing in this video, before that please read this standard disclaimer. Okay, let's go for the strategy now. The strategy is the positional BTST options strategy which I am going to use. Most of the time I use this strategy for the BTST. In case if I am wrong, I may hold this position for 1 or 2 days or even for 1 week also. Sometimes we may be wrong. In that case we have to wait for the market to move in our direction. For that it will take some time. Okay, so the strategy name is the bull call spread or bear put spread. Either put side or call side I am going to trade this. Every day evening by 3 o'clock or by 2:30 I am going to take the position and wait for 2-3 days. Even in case that opens gap up or gap down next day, immediately I will exit. If the trade goes against to me, I will try to do some adjustments to reduce the loss, or I will do the intraday trade to come out of the minimum loss. Okay, these are the things I use most of the time. So this is the plain chart. When we see the chart, right, stock analysis, first let us try to decide which strategy we wanted to trade on the stock. This is the Reliance chart. Okay, when we see the raw price action, we will not have the more details about it. Okay, let me try to draw the trend lines. Okay, what happened here is the market, okay, the Reliance stock traded in the range for reasonable amount of time. Okay, after trading in this range, right, the stock breakout happened and went for the till this point. Okay, till this point. Let me try to draw further thing. After that, what happening was, after that it made the high of this level. Okay, then started falling. So after falling this, right, this is the high. This is the high, next high, okay, which is failed to break it. That means the stock started making the lower lows. Okay, this is the first sign for me to be in the bearish side. Okay, so assume, and also the second reason is the stock is trading in the channel. The channel got breakdown here, it may be retest for here and slowly start falling till this point. Okay, now I wanted to capture this fall which is around 1 or 2%, okay, in the shorter time frame. This is what my intention. So the conclusion here is the stock is transforming from the bullish to bearish, or it is coming for the retracement, some retracement. We never know what is going to happen. So this is what my intention, my conclusion on this stock. Now which strategy I wanted to go. Since this is falling, let me take I wanted to buy a put option here. Okay, buy the put option. If I buy the put option, what happens is, okay, let's take a chart, the stock, right, the stock, this Reliance volatility is very less. If we see the daily volatility is 1.26 percentage. Okay, so the volatility is very less. It may fall or may not fall. It may take a couple of days to fall because the stock nature and the volatility, daily volatility, the stock may not fall very quickly. So in that case, what happens? My buy position, put option in the bearish side, I am going to take. There could be some decay. Okay, this decay, how much decay? All those things I will discuss. So to avoid this decay, equal amount of the decay I wanted to capture, or half of the decay I wanted to capture. So what I am trying to do here is, wanted to sell another PE to avoid the decay. So here some decay I am going to lose because of the buy position, time decay. Another sell position I am having, I wanted to gain the similar amount of decay or half of the decay from this sell position. So now I wanted to buy one PE and sell another PE. Okay, this is the strategy. So which put option I wanted to sell and which put option I wanted to buy. Okay, this is where the strike selection will come. Usually for the strike selection, I go with the one delta model. Okay, one standard deviation model is one mechanism to select the strike. Other mechanism is, okay, this is the standard deviation mechanism. Second one is the delta mechanism. Okay, this is the delta. These two methods I wanted to, either one of the things, both are accurate. Most of the time I use this delta methodology because for the standard deviation calculating we need a calculator, all those things. Okay, why one standard deviation? One standard deviation is the probability of the price below the one standard deviation is 60%. Okay, the 60% of the time the stocks, most of the stocks trade below the one standard deviation from the mean. Okay, if it is 20 moving average, if you take, this is the mean, if you calculate the standard deviation from here or the standard deviation from here to here, okay, 60% of the time this trade in the one delta. This is the reason I wanted to take the strike price, my spread, the spread, this spread I wanted to be in the one standard deviation because 60% of the time this trade in this range. That is where one standard deviation I want. The second methodology is delta. That's why delta methodology I use is, let's say for example, what is the delta? At the money means, okay, at the money means the probability of the particular strike falling into the in the money is 50%. There is a 50% chance that whatever the strike you are selecting, probability of falling into the in the money is 50-50 chances are there. So let me take my PE. I bought a 50 delta. Okay, the probability of going into the in the money is 50%. That means this is the one of the meaning for the delta. The second meaning is, when your trade is going wrong, you are going to lose 50 paisa. Every strike move you are going to lose the 50 paisa. This is the delta meaning. Okay, for the particular strike if you take every 1 rupee move, you are going to lose the 50 paisa in case against to you. Okay, if it is in the favor, you are going to get the 50 paisa. Okay, then the sell right, let's say my trade went wrong against to me, I am going to lose the 50 paisa. Okay, at the same time the delta, whatever the premium, let's say 50 rupees I am having, that means the delta is 50. Okay, 25 rupees is the 25 rupees is the actual premium, remaining 25 rupees is the time value. Okay, there is a decay of this time value which is 25 rupees for example. So this 25 rupees is the purely time value. If you take any strike which is out of the money, the actual premium value is very less. The most of the premium, most of the thing is time value only. Okay, the time decay for the out of the money is very more. So here I wanted to take close to the other money where I am having the real money and time value. Time value, whatever the time value equal to the time value I wanted to sell, so that whatever the decay, the time value, time is going to move towards to the expiry, the time value which is going to decay, similar amount of the time value I wanted to get from the other strike to sell. Okay, this is what the meaning for this spread. So the delta model which I am going to use is most of the time I use 40 to 45 delta for buying. Okay, 17 to 25 delta for selling. Okay, these are the formula I use if I go for the delta model. If I go for the standard deviation model, what I do is take other money, okay, call option plus put option premiums. Let's say call option I am having 70 rupees plus put option I am having 70 rupees, or for the simplicity, for the calculation purpose, I take call option I am having 100 plus put option also I am having 100, or you can take call option is 50 plus put option is 50. Any one of this is the example. If I take in this case, right, total premium is going to become a 200. In this case, total premium is going to become 100. Okay, let me take 200. What is the probability? 1 delta. 1 delta is the standard deviation. Probability of staying the price within this 1 delta is 60%. That means for the 200 strike, I wanted to get the 60% from this. What is the 60%? 120 rupees. Okay, 120 point spread. Okay, I wanted to get my spread between this buy and sell. This is the buy and sell. Between this, I wanted to have this 120 difference. Okay, that is where I get 1:2 more than 2 risk reward. 1:2 more than 2 risk reward. These two methodologies I am going to use. Okay, let me go to the chart now. As per the chart, we decided to trade in the bearish side. Let me go to the Reliance. I will try to select the strike prices here. Very simple. Okay, let me go to the builder. Two methodologies I am going to show you. The first method, let me take the first method as a delta mechanism. The delta what I mentioned here is, in case of delta, 40 to 45. Okay. $40 to $45 delta is buy. Okay, 17 to 25 is sell. Okay, let me go to this 40 to 45 delta. What is the price or the money, right? 27.13 is there. That means 23.10 is not there. 27.20 is there. For the 27.20, let me go to the February. This is January month, okay, already we are very close to the expiry, we don't want to entertain that. So this is the other money. What is the other money? 43 delta is there. Okay, if we go for the 43 delta, our what is the our criteria? Between 40 to 45. Okay, let me take between 40 to 45 delta. Okay, this is also okay. This is close to the 40. This is also okay. This is also okay. Let me take both. Okay, I am buying this delta 62. Okay, and what is the delta we wanted to sell? 17, between 17 to 25. So what is the, here we took it as a lower higher range. Let me go for the somewhere 21 or this one. Okay, I am going to sell this one or that one, anything is fine. Okay, we have to check what is the risk reward. 1:1.96. okay, we didn't get the proper risk reward. So what we are going to do is, we will try to select another strike. Okay, where this is the strike I wanted to sell, or this is the strike I wanted to sell. Between that we have to try. Now what is the risk reward? I got 9,288 is the my loss, 20,000 is the profit. I got 1:2 risk reward, right? This is the strike selection I have done. The second mechanism, let me try out the same way. You can, I told you, right, this one also fine. You can buy this option around 40, go to the 17, around 17, sell this. Okay, 17 to 25, you can check in that you are having the better risk reward, 21, 18. Okay, this is how you can select the strikes. This is one of the mechanism. The second mechanism, what I told, one standard deviation. One standard deviation is 60%. 60% of the other money premiums. Let's take, okay, what is the other money? This is the other money. 83 points is there, call option. 62 points is the put option. Okay, let me go to the 83 plus 62, it become 145. 145 into 60%, right? 0.6 equal 87 points is the range. We need our spread to be between 80-90 points. Okay, so 80 points range we need. Go to here. You take other money. I don't want to buy other money. I wanted to buy little outside. Buying this 2,700. From here 80 points away. Take the 80 points away. Okay, 20, 40, 60, 80 points away. Sell this. Same way, right? We got 1:2. See, we got 1:2.5. The risk is 6,000 rupees. The reward is 13. 1:2. Here in this mechanism, the risk is even less. Okay, this is how the strike selection should be. Two methodologies. One method is delta methodology, where no need to have this calculator, all those things. Most of the time quick trades I wanted to take in the delta methodology. Or you can go with the standard deviation. Why one standard deviation? The probability of price trading between one standard deviation -1 to +1 is 60% probability is there. That is where we wanted to go with this range. Okay, within this range, so that we will be having the good probability. Okay, here the probability is 41% is there. So this is where we wanted to go, this kind of two methodologies. Now what we did, we concluded, okay, we concluded stock analysis. We did, based on this analysis, what we concluded, this is having the mild bearish sentiment, so we wanted to capitalize that bearish sentiment. If we buy put option, there is a decay. To avoid the decay, we are going to sell the counterpart, which is another leg, the same instrument with the same expiry put option. So strategy selection based on the view. What is the strategy? The put option spread. What is the sentiment? Bearish sentiments. Bear put spread we are making. The strike selection based on the risk reward. The strike selection, two strike selection criteria I found. Okay, I found in the sense not invented by me. Okay, I got from the some research, some study by trying trial and error methodologies. I found, and a later point of time I do concluded, and many times I traded like this. So the strike selection is good strike selection. The stop loss and adjustments, okay, the maximum stop loss we have to keep based on the chart levels. Once this breaks this, right, once this breaks this, there is no point of holding the position. Okay, it may go higher, we may get the loss. Okay, by the time it reaches here in the strategy, let's take 2800. If that breaks in another 4-5 days, okay, for example, next 4 days, another 5 days, if that breaks, right, how much we are going to lose? Maximum 2000 rupees we are going to lose. This blue line, right, maximum 2000 rupees. Okay, we can give, if when we are wrong, we can give something to the market and come out of it. Otherwise, if still you wanted to fight with the market, I will show you another mechanism. Okay, for example, I took the trade of TCS. Okay, I made some amount which I already showed in my Telegram channel. Okay, let me show you the TCS trade. See the positional TCS trade, the bull call spread I made 1:2.74 is the risk reward. Next day what happened? It opened with 1.5 gap up. Okay, I got the 14,000 rupees in the profit, and last side 4,000 rupees. See, maximum most of the time 5,000 per lot within 1 or 2 days is very good profit. I wanted to exit. No need to fight with the market. Okay, reasonably good amount if we get very quick short term, right? That means what is the amount we wanted to make this strategy. Okay, for example, I already made this strategy. Let me show you. The amount required for this strategy, estimated premium is around 30,000 rupees. For 30,000 rupees, if you get 5,000 rupees, which is very good returns within a day. Okay, so in case, this is what I made. In the same way, I do made in the position where I am the wrong. Okay, when I am wrong, in the first level adjustment, what I do is, okay, let me, the original position, I am modifying to the original position. Okay, this is my original position. 16,000 is the profit. My maximum loss is, my maximum profit is 28,000. Maximum loss is 16,000 rupees. So my view went wrong. Since this is February, I am having the hope that IT sector may perform. So now I am having some amount here, around 4,000 rupees. I wanted to capitalize. For capitalizing that, what I did was, I did some shifting. See, I booked the profit of 3,825 rupees. I shifted to the next strike, which is closer to the 490. So the premium also similar premium I wanted to collect from the sell side. Okay, this is how I made. In case, even if the market goes down, what I wanted to do is, okay, I wanted to sell one more this, and make my trade is like this, similar to this. Okay, wherever it goes downside, I will not get any money. This is the ratio spread we can call. 1:2 ratio spread to match the premiums. This is one of the mechanism I do. So when again it gaps up of more than 10%, 15%, there is a probability of losing more money. To avoid that, what we wanted to do is go to the far out of the money where you can buy one more leg, so that okay, the loss will be minimized and the loss will be limited to the 24,000. So until your trade comes into the profitable, what I do is I will keep changing the strike prices up and down, try to make this loss to zero and to come out of the trade. Because when you are wrong, right, fighting with the market is the idiotic thing. So what we have to do is we have to give something to the market, prudently come out from the market, or try to minimize your loss by doing the adjustments. Remember friends, please remember that adjustments will not give you the money. Okay, the markets, whatever the people, they are selling the courses by showing these adjustments, right? Adjustment may not give you the money. Adjustments always try to reduce your losses or reduce your profits, limited to the profits, to come out of the trade with small profits or minimum losses. For that purpose, adjustments will help. What is the meaning for adjustments? Book one price, okay, one strike, and initiate other strike, which is equivalent to the like exit from the trade, re-enter into the trade. Okay, both are same in my views. That is where I don't give the more importance for the adjustments. Okay, this is how we have to, when our trade goes wrong, right, these are the minimum small things, small bare minimal adjustments I do and come out from the trade. That's all friends. Okay, now what and all I discussed how to analyze the chart. Okay, to conclude the market view. Once we conclude the market view, which strategy we wanted to take, bullish side strategy or bearish side strategy. Once we do the bullish side or bearish side, then what are the strikes we need to select. Okay, how to select the strikes? See, we shouldn't select the strikes randomly here and there. Okay, so we are having some professional mechanism, some well defined mechanism to take the strikes. Once we select the strikes, initiate the trade, give the time for the market. That may be 1 day, 2 day, 3 day or 4 days. If the trade goes into your direction, once you get your defined profit, whatever the profit you are thinking, most of the time for me, per lot, if I get 5,000 rupees, which is very good, so I will try to book the trade. Okay, that's all friends. Okay, this video, whatever the content I made, this is the complete information I am giving about my BTST strategy. If you feel this is good, okay, please, and also if you feel this is useful for your friends also, please share this video to your friends, and also try to subscribe for my channel. That will motivate me to make more videos on this educational content. Okay, thank you so much friends. This is my Telegram channel where I do update, I do post some regular information. What are the trades we are going to take? Okay, what is the status of the trades? Regularly I will be active in this. Okay, YouTube, sometimes I will make some videos, educational videos. Okay, in case regularly if you wanted to be interactive with us, be part of this Telegram channel, The Money Breeder. Okay, thank you so much friends.